For now, the management on the show is Ashok Leyland. It's the first management on the show. It reported a muted set of numbers, but gave a very strong guidance of mid-teen margin growth in the medium term. Also, the company is eyeing new electric vehicle launches in the next 2 months. To discuss all this and more, we have Shenu Agarwal, the Managing Director and Chief Executive Officer at Ashok Leyland. Mr. Agarwal, good morning. You saw single-digit growth on the top line for Leyland this quarter. Could you explain what went down, and do you see this muted growth continue, not just for Leyland, but for the industry itself?
Yeah, see, at the beginning of the year, there was a widespread anxiety that CV industry may go down by as much as 15% in H1. And I think this view was developing because of the impact of elections. And at that time, there was some amount of uncertainty with the monsoons as well. But now Q1 M&HCV industry has grown by 10%. Yeah, so I think that has set a very, very positive momentum for the whole year. Even in the beginning of the year, research agencies were of the view that market M&HCV industry would be down by 4 to 7%. But now, since we have grown by 10% as an M&HCV industry, I think the outlook is changing. Now, also because of all the economic measures that have been announced in the budget, I think the positivity is building more actually. So we are very optimistic about Q2 and for the rest of the year as well.
Okay, you're very optimistic about Q2 and for the rest of the year. Got that. You said M&HCV growth for the industry is 10%, but your own revenue growth is only 5%, which means you're perhaps seeing some weakness in other segments like LCVs, etc. And is it fair to assume that you will see a single-digit top-line growth for the full year FY25?
Yeah, definitely. I think, M&HCV industry has grown by 10% and we have grown more or less in line. Our growth in M&HCV has been 8%. So we have still retained our market share close to roughly 31%. While LCV industry has degrown slightly or is kind of flattish, but our volumes have grown. So we have gained market share in LCV by about 1.1%. I think the only reason that we have not shown appropriate or on the top line is only because on the power solutions business, our volumes have degrown by about 19 or 20%, and so is the revenue. And the reason for that was that Q1 of last year, we had a lot of pre-buy. Right, so that is because that is why the Q1 power solutions business has not performed that well as compared to Q1 of last year. But I think going forward, even power solutions business will do well. Our defense business is doing really, really well. We are doing very well on aftermarket business also. So yes, as I said, we are very optimistic about the industry, and of course, at Ashok Leyland, we will try to beat the industry growth.
All right, Mr. Agarwal, let's focus on margins then. There was a big fall on a quarter-to-quarter basis to around 10.6%. But do you expect more pressure on margins? I ask this because raw material costs as well have gone up a little bit.
Not at all. We are very, very clear that on margin front, we will continue to do better. We are also very clear that we are not going to discount our products to win market share. We are also clear that market share has to come on the back of the superiority of the product and also our ability to give a delightful experience to our customers. Yeah, so on profitability, we are not going to compromise at all. Like you said, Q1 of last year, we were at 10.0% EBITDA, and now we have already improved it to 10.6%. I think going forward, we will continue to focus on profitability. Even on the commodity side, we don't think that there is anything to really worry. I think the commodity prices are quite stable. We are actually getting benefited from the commodity price. But also at the same time, our focus on cost reduction internally is going through a lot of rigor. Even last couple of years, we have had record cost savings. Even this year, we have a lot of visibility to save cost. So I think altogether, the industry is performing well. Ashok Leyland will gain market share. The commodity prices are helping. Our cost saving is showing a lot of promise. So I think given all this, our margins should improve going forward.
Okay, so when you say that your margin should improve going forward, right, what kind of margin growth can we expect? You're sitting at an exit margin of 10.6% in Q1. For the rest of the year, what are we looking at?
Yeah, see, what I can tell you is that, quarter on quarter, when compared to last year, we will continue to improve our margins. It is very hard to give you a particular number, but I can again say that we are very, very focused on margins. To us, market share will not come from sacrificing margins. Market share will only come from the superiority of the product and superiority of our customer service. So market is doing well. The commodity pricing are good. Cost saving is at its peak. So we don't think we should look back now on the margin front.
Okay, what kind of growth do you see for the LCV segment? Is there a double-digit growth expectation? I'm asking because a lot of these segments like e-commerce, white goods have started to see, quite a bit of traction. So on LCVs, what are you looking at?
So on LCV side also, we are quite optimistic, although quarter one has remained quite flattish on the LCV side, but we think the momentum will come after this budget announcement. I think a lot of positive sentiment is developing around LCV. I think there has been very, very good forecast around the e-commerce growth and white goods growth, right? So all that should really help LCV. I am very confident personally that we should see much better growth rates in LCV going forward. Now, as far as Ashok Leyland is concerned, we are preparing to launch 6 new products in the current fiscal year, 2 of which we have already launched in Q1. The balance 4 we will launch in the subsequent quarters. So on the LCV front, also we are quite hopeful that we should be able to beat the growth levels of the industry.
Okay, we'll let you go at that, Mr. Agarwal. Thanks a lot for joining in here on CNBC TV 18.